What are the accounting entries when paying a dividend to a holding company? Once we have assisted our clients when it comes to the insertion of a new holding company, which is the tax advisory and the implementation, a common question that we usually receive from the client or the accountant or one of the accountancy firms that we are partnered with is, what are the accounting entries or queries around the real life implications now of the group structure, and usually from an accounting perspective. Now, luckily for you, I am a qualified accountant and I taught ACCA and ACA for many years as well. So I'm qualified and well-versed, experienced. I think experience matters a lot more in terms of advising on the accounting entries between the subsidiary companies and the holding company. Under UK tax legislation, specifically the Corporation Tax Act 2009, dividends paid from subsidiary companies into the holding company are completely and specifically exempt from UK corporation tax. And this is one of the many reasons why a holding company group structure is usually implemented. Why? Because the subsidiary company or the shareholders can extract funds from the trading company, the bottom property investment company, completely tax-free into the holding company without paying large amounts of dividend tax, up to 39.35%. Moreover, it allows for reinvestment into other assets such as property, stocks and shares, cryptocurrency in a tax-efficient manner. You're not losing up to 40% and incurring unnecessary additional tax liabilities. The accounting entries to record such a dividend. So we're saying the subsidiary company, you might have one subsidiary, HoldCo, you might have multiple, you might have 5 subsidiaries, one holding company. Your structure, it just depends on specific circumstances, but ultimately a dividend going from a subsidiary into a holding company, it's in the subsidiary company debit retained earnings or reserves, whatever you want to call it, by the amount of the dividend, which, let's say in this example, £100,000, and credit cash. Why? Because cash is being decreased, right? Cash is leaving the subsidiary company. And just keep in mind that the transaction has to occur in real life. So the £100,000 must go from the subsidiary bank account into the holding company bank account. It's not just a, paper transaction in that sense. Obviously, you accountants would know that there are ways to deal with this matter. But as I say, debit retained earnings, credit cash in the subsidiary company. In the holding company, it's the opposite when it comes to cash. So we debit cash. So when we're looking at things like dead click, for example, debit expenses, assets, cash is increasing in the holding company by £100,000. And what is the credit entry? The credit entry is dividend income. I hope that makes sense. I hope that was useful. So in the subsidiary company, debit retained earnings, credit cash. In the holding company, debit cash, credit dividend income. I hope that helps. My name is Omar, Chartered Tax Advisor, owner of ASWATAX, a UK and international tax advisory firm. Don't forget to like, comment, share and subscribe, and I hope to bring you a lot more informative videos as we go along. Speak to you soon. Thank you. Bye.